But really the most I learned is by actually doing it, getting into those spreadsheets, diving into the formulas, and actually going through the packages and underwriting those deals. So it was a combination of taking action and then continuous education. And I'm still learning. Underwriting is an art and a science. It's constantly evolving, and that's what I love about it. So I still feel like I have a ton to learn.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Vessi has 18 years of business experience that includes 14 years of commercial lending and 4 years of business management and sales. Today, Vessi controls over 161 doors. Vessi, welcome to the show.
Thank you so much, Sam. It's a pleasure to be here and excited about our conversation today.
Absolutely. The pleasure is mine. Vessi, there are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Happy to share that. So one could argue that my real estate journey, or the seed for my real estate journey, was planted back in Bulgaria behind the Iron Curtain, when not many people knew, or there wasn't really a developed stock market. And so when people talked about investments, in most cases, they would refer to hard assets like real estate, precious metals. But that seed didn't quite germinate on my end until 2017, when I made my first investment after arriving to the US and really following the more traditional path of going to school, climbing the corporate ladder. So I made that first investment out of state. I live in Los Angeles, California, where there are great natural appreciation benefits, but it's very difficult to cash flow. And since cash flow was my goal, that kind of forced me to look out of state. So I started in the residential space, actually in Memphis, Tennessee, buying a single family home there, and then another and another, eventually expanding into the Florida market. And I asked myself, how do I scale this further? And that naturally led me to look into multifamily. I started devouring a ton of content, joined a mastermind, started underwriting, evaluating deals, and officially made that transition earlier this year by closing on 2 deals. One is a JV in Tampa, and the other one is a syndication in Augusta, Georgia, and continuing to look to grow and scale in the multifamily space.
That's fantastic. How many single family homes did you have before you said there's got to be a better way?
I got up to 4 properties, 5 doors, and that's when I figured I need to start making that shift.
Good for you. That's, I hear a lot of guests who come on and they're like, we've had 20, 30, 40 doors, and then like, wait, we can't meaningfully scale this. So you must be smarter than the rest of us in that you learned your lessons earlier on. So well done. That's fantastic. So you got out of single family, you said, and were all those, I'm assuming, were those turnkey properties? I mean, were the things you were managing yourself? What were those single family residences?
Yeah, I started with turnkey rentals, and I do have third-party property managers who are my boots on the ground and that I vetted before really making that leap. So I don't self-manage those. I definitely manage the manager, and certainly learned quite a lot that I could transfer onto my multifamily portfolio.
That's great. And you said your first deal you got into in the multifamily space was a joint venture. Tell me how that deal came to you, and you'll break down the structure of the joint venture, maybe for our listeners who haven't done a joint venture yet, or maybe even how that came about.
Absolutely. So what I decided to focus on are 2 things at the beginning of my multifamily journey. One is a market. So I selected the state of Florida since I already had some presence there, a property manager, boots on the ground. And the second part was the skill set, and that's underwriting, acquisition. Particularly in the state of Florida, as I was doing my research, I quickly found out that 92 to 93% of the deals are sourced via brokers versus going direct to seller. And since I still have my full-time W-2 job, I decided to focus on the 92, 93% of the market. So I started reaching out to brokers, eventually getting on their lists to start receiving deals to analyze. And every deal I would analyze, I would always respond to them with feedback on why it doesn't work at that moment of time, and kind of reminding them of what my acquisition criteria are. And so that was quite a bit of a journey. It took about 6 months, underwriting nearly 200 deals. So that's a deal a day. Of those, only 5 were LOI worthy. And of those 5, only one actually won the LOI. And that was an 11-unit Class B property in the market of Tampa. It wasn't large enough to syndicate. However, through a mastermind that I had joined, I already had connections with potential JV partners, one of which was or still is in Florida and served as boots on the ground. So we joined hands and went after the opportunity. I can talk about the closing process as well, because that wasn't smooth sailing, to say the least. But we were able to get it done, and now working on stabilizing the asset.
No, that's really cool. I love that story. Did this joint venture partner approach you, or did you approach them?
I approached them, and so as I was looking for deals in parallel, I was looking to continuously reach out to people, build relationships, really make sure that the people I work with have similar values, similar goals. And so there were a lot of conversations that were taking place kind of behind the scenes, if you will, over a period of time. And that really allowed me to get to know the people that I'll be working with. That particular mastermind also facilitates in-person events, so I had a chance to meet them in person. So it really happened organically over time. So by the time that I had the deal on the table, I already had the infrastructure set up in order to take that deal down, not only from a partner's perspective, but also having an insurance agent, the property manager, everything lined up so we can execute smoothly on the transaction.
What was the purchase price on that 11-unit deal?
2.1 million.
2.1 million. Okay. And so your joint venture partner brought all of the equity. Is that right?
That's not right.
Okay.
So there's four entities, and we're split 30-30, 20-20. And so I have a larger share, mostly because of finding, organizing, setting up the deal, underwriting the deal, and really having a more active part in the asset management. However, everyone has their role. We all have weekly JV calls. There are certain partners who help with the boots on the ground aspects, some of the contractor pricing and vetting, taking minutes, reaching out to local vendors, and then we have various projects that are taking place. So each person has a role in that project. So it's not just me. And that's been really helpful. You often hear that multifamily is a team sport, and I could not agree with that more. Could I have done this on my own? Maybe. But I think in the long run, it will be very difficult to scale if you were to do this on your own. So it's been amazing to have the help from my partners.
That's absolutely right, and that's something that we talk about a lot is the you've got to have partners if you're going to scale. What's that line? The if you want to go fast, go alone. If you want to go far, I can't remember the rest of the phrase, but something like goes a group or as a team, something like that. If you guys are listening to this, you're probably like, you got it completely wrong, Sam, and you're right. I probably butchered that, but you get the big idea there. And that's funny because I had an investor call here, with me 2 weeks ago, maybe, and they're like, how many partners are on this deal? And I said, well, there's 4 of us, and they're like, why are there 4 of you? And same question they posed to me, and I'm like, well, let me just explain to you why there's 4 of us, because here's what the 4 of us are doing. And they're like, oh, that's a lot. I go, yeah, I just can't do it on my own. So, I could, maybe if I were, this was all I did, that one single deal, maybe, but even then it would be just a lot. Tell me about the 200 deals that you underwrote. I mean, that's a lot of underwriting and a lot of patience and a lot of
Yes.
feedback to brokers going, hey, this doesn't work. I mean, did the brokers get tired of hearing from you saying no? I mean,
I mean, probably, and that's always a risk you take. But at the same time, I think it's even worse if you are kind of silent and constantly pulling deals because they see who's pulling the deals and the
right.
packages, and of course they share that with their investor list. So there is a way to track who's actively looking at these deals. So I I certainly didn't want to be the person who's only taking information and not giving them any feedback. And it's helpful for them to get that feedback because then they share that with the seller. And certainly we're entering different waters in the current market environment. But at the time when I was looking, everything was extremely competitive, definitely a seller's market. So having that feedback is important. And yes, it took a lot of tenacity, but at the end of the day, it's important to know also why you're doing it. And my why is what was driving me. I think having clarity of goals and your why will pull you up further during good times and push you forward during tough times. It certainly was not easy, especially when there's a lot of noise around and you hear people closing deals left and right. And here I am still trying to find the one. Also, I will say that especially in the beginning, a lot of these deals I underwrote for reps because I really wanted to master underwriting. So even when I got a deal that I knew right off the bat probably won't meet my investment criteria due to submarket location or maybe age of the property, this and that, I would still go and underwrite it fully, so I could develop that muscle memory, if you will, of being very efficient in analyzing deals. And what that helped me also over time is learn the market, learn expense line items, vacancies, everything that you need in order to more accurately project the performance of the property. So it was a learning exercise, but also a way to build relationship with the broker community.
No, I think that's absolutely great. I mean, it's what a skill set to have really honed. Did you have any guidance along the way helping you kind of define or refine that skill set?
Absolutely. So I joined a lot of, there's a ton of online groups or communities that specialize in underwriting. There are also books and a ton of content that you can devour, if you will. So I definitely took advantage of that. Also within the mastermind that I'm part of, people ask questions, support each other. So I definitely utilize those forums. But really the most I learned is by actually doing it, getting into those spreadsheets, diving into the formulas, and actually going through the packages and underwriting those deals. So it was a combination of taking action and then continuous education. And I'm still learning. Underwriting is an art and a science. It's constantly evolving, and that's what I love about it. So I still feel like I have a ton to learn. And as the market evolves, you evolve your underwriting with it. So it's not something static, it's something fluid that constantly changes over time.
What would you recommend if someone, and maybe you already answered this by saying the online community, books that you can use, things like that. This is a conversation actually that came to me yesterday with somebody, and they said, hey, I want to learn and master underwriting. And, I've done my fair share of it, but I'm not sure I've mastered it. It's not something I spend my everyday doing. But if someone were to follow in your footsteps, what would you tell them to do if they wanted to, other than maybe getting their reps in, but to learn and master underwriting?
So I would start by encouraging them to select a model. There are a lot of different underwriting models out there. And when people ask me which is the best one, my response is usually the one that's best for you. So
Right.
go ahead and try different models. Some are free out there. For example, Robert Beardsley has one, and he wrote a book on underwriting that I've definitely read, and I've use his model. So that would be one. They're paid ones. The ones I've used most frequently is the Michael Blank syndicated deal analyzer. And there are a ton more. So I would encourage people to experiment, see the one that's suits them best. And if you're an Excel guru, over time you can also build one of your own, because there's always something lacking in each model. It's not going to be perfect, but I would start there. And then joining various underwriting communities. So Saturday, there's like a 3-hour meetup focused on underwriting led by Charles Siemens. So that's one I attend regularly. That's a good way to start. And of course, if you're part of a mastermind, there are subgroups there. But those would be a few ways to get started, is picking up a model and start to analyze deals. Maybe pick a deal, maybe not in your market if you're too afraid to start reaching out to brokers in your market, but start analyzing, and maybe team up with a buddy where you can compare notes and learn along with each other.
That's awesome. That fantastic list of resources there for our listeners. Thank you for sharing all of that with us. One final question here for you. Maybe this will lead to other questions, so maybe I lied there. But tell me this, how has your underwriting changed in 2022?
That's an excellent question, and I probably would have answered it differently at the beginning of the year, but a lot has happened since the Fed started raising rates in March of this year. There are a few changes that I'm making in my underwriting. From a top line perspective, certainly moderating my rent growth assumptions to low single digits versus high single digits or low double digits. So that's one. Normalizing the vacancy assumptions as well, because occupancy levels are starting to decline, and that's just part of the market cycle that we are in. On the expense side, being even more diligent with my insurance assumptions, particularly in Florida. Rates have increased exponentially, and in some cases, it's not uncommon for them to, the preliminary quote that you received from your broker to change by the time you close. So constantly staying in touch with the insurance broker to make sure those rates are relevant. Increasing my reserves for operating expenses and CapEx. On the CapEx front, that's partially driven by the labor and supplies, material costs, and then operating reserves, just building in more cushion, at least 6 months, in order to have that protection should the market turn even more sour. And last but not least, cap rate reversion. I know historically, most people look at a 10 basis points per year increase. I've accelerated that just based on what I'm seeing in the market today. And one example I would give is in the Orlando market, cap rates are currently at 4.7 versus 3 same period last year, and most assets are now trading at 5. So that is real, that is happening, and not surprising, right, given the pace of the interest rate increases. But those are some of the changes I've started to make into my modeling and projections in order to get more realistic, or one could even say more conservative projections and assumptions.
I love it. Those are very tangible things that you're doing in your underwriting that really make a big difference in the amount in the beginning. Obviously, the amount of money you're willing to pay for an asset, which is
absolutely
that's a big
certainly also yes, and it's fortunately or unfortunately, right, depending. I like to be conservative, but it's also resulting in return compression, which is now making deals even more difficult to pencil in, mostly because, at least from my experience, while there has been some adjustment in seller expectations, maybe 10-15% of the list price, those seller expectations haven't fully adjusted, and that's what's leading to that overall return compression.
Right. Yep. And that takes time for people to get realistic on what their assets are worth. I know I certainly made an offer here last week on an asset, and they came back with another number, and I just said, we'll just give this a little time. I know in the next 12 to 18 months, we'll probably have a deal, but we're going to have to give this a little time. So that's just the way it goes. Vessi, thank you for taking the time to come on the show today. Speaking of time, if our listeners want to get in touch with you, what is the best way to do that?
The easiest way is to connect with me through my website, dbacapitalgroup.com. D is in dream, B is in believe, A is in achieve. I have a ton of free content there to share with your listeners. And of course, there's my phone number, my email, as well as a link to my calendar should they want to continue the dialogue.
Fantastic. Vessi, thank you again. Have a great rest of your day.
Thank you so much, Sam. Have a wonderful day and week ahead.